In this video we are going to talk about Warren Buffett's investing rules. So before starting this video, please like this video and subscribe to this channel for our future updates. Rule number 1. Never lose money. Rule number 2. Never forget rule number 1 inch. Buffett personally suffered a loss of approximately $23 billion during the financial crisis of 2008, and his firm, Berkshire Hathaway, was stripped of its prestigious AAA credit rating. So how does he claim that we will never lose money? He's talking to the mentality of a prudent investor when he says this. Don't waste your time. Don't take chances. Don't enter into an investment with the mindset that it's okay to lose money. Make sure you're up to date. Make sure you complete your homework. Buffett only makes investments in companies that he has extensively researched and understood. He does not enter into an investment with the expectation of losing money, and neither should you. Buffett feels that temperament, rather than intellect, is the most important trait for an investor. A successful investor does not place emphasis on whether or not they are in agreement with the crowd. The stock market will experience volatility in the near future. Despite this, Buffett remains focused on his objectives in both good and bad times, as should all investors. This prestigious investor rarely modifies his long-term investment plan, regardless of how the market performs in the short term. If the business does well, the stock eventually follows. Following the publication of Benjamin Graham's book The Intelligent Investor, the British-born American economist, professor, and investor, who is also known as the father of value investing, Buffett came to the conclusion that investing in a stock is equivalent to owning a piece of a company. As a result, when Buffett is looking for a stock to invest in, he looks for companies that have strong long-term prospects. Is the company's operating history one that has been consistent? Is there a dominant business franchise in the area? Is the company generating profit margins that are both high and sustainable? If a company's stock price is trading below analysts' expectations for its future growth, it may be a stock that Buffett would be interested in purchasing. Buffett never purchases anything unless he can articulate his rationale for paying a specific price per share for a particular company in a written document. It is recommended that all investors follow the same procedure. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett is a value investor who prefers to buy high-quality stocks at rock-bottom prices, which he calls rock-bottom prices. His true ambition is to increase the operating power of Berkshire Hathaway by purchasing stocks that will generate consistent profits and capital appreciation for many years to come, rather than simply increasing his personal wealth. When the markets were reeling during the 2007 to 2008 financial crisis, Buffett was stockpiling great long-term investments by investing billions of dollars in companies such as General Electric and Goldman Sachs, among others. In order to make good stock selections, investors must establish criteria for identifying good businesses, and then adhere to those criteria. For example, you might look for companies that provide a long-lasting product or service, as well as those that have strong operating earnings and the potential for future profits. You might set a minimum market capitalization that you're willing to accept, as well as a maximum price-to-earnings (P/E) ratio or debt level that you're willing to accept. Discovering the optimal combination of company and price, as well as a margin of safety against unforeseeable market risks, is the ultimate goal. It's important to remember that the price you pay for a stock is not the same as the value you receive. Successful investors are well aware of the distinction. Our favorite holding period is forever. How long should you keep a stock in your portfolio? The investing guru argues that if you don't feel comfortable owning a stock for the next decade, you shouldn't buy it for the next 10 minutes. Even throughout the period he referred to as the financial Pearl Harbor, Buffett remained committed to his investment strategy and retained the majority of his holdings. Unless a firm has experienced a significant change in its prospects, such as severe labor troubles or product obsolescence, a long holding period will prevent an investor from behaving too humanly in their decision-making. Being overly scared or overly greedy might prompt investors to sell stocks at the bottom of the market or buy them at the top of the market, resulting in a decrease in long-term portfolio appreciation. Warren Buffett has made it plain that he believes in the buy and hold philosophy. A number of his roles have been with him for many years, if not decades. Why? In the first place, it's difficult to locate exceptional businesses that have a promising long-term future. Buffett runs a concentrated portfolio for this reason. A quality business, on the other hand, generates significant returns and increases in value over time. Time, as Warren Buffett has said, is the wonderful business's best friend, and this is true. Fundamentals can have a long-term impact on a stock's price, and only the most patient investors will reap the rewards. Finally, trading activity is a major detractor on the performance of investments. Trading stocks on a regular basis consumes returns in the form of taxes and trading commissions, reducing overall returns. Instead, it is often preferable to purchase correctly and sit tight, as the saying goes. Diversification can be dangerous. If an individual investor holds between 20 and 60 companies across a variety of industries, they will reap the greatest number of the benefits of diversification. Many mutual funds, on the other hand, include hundreds of equities in their portfolio. Warren Buffett, on the other hand, is the polar opposite. Buffett's largest holding in 1960 accounted for a stunning 35% of his total investment portfolio. Just to put it another way, Warren Buffett invests with complete confidence in his best ideas, because he understands that the market rarely provides excellent firms at reasonable rates. An excessive amount of diversity also implies that a portfolio is likely to be invested in a lot of substandard enterprises, diluting the impact of the portfolio's higher quality holdings. Diversification serves as a safeguard against ignorance. When it comes to people who know what they're doing, it makes absolutely no sense. Billionaire investor Warren Buffett. Most news is noise, not news. According to the 80-20 rule, approximately 80% of the outcomes may be traced to around 20% of the causes of an event or occurrence. It's more like the 99-1 rule when it comes to financial news. In my opinion, minus 99% of the investing decisions we make should be ascribed to just 1% of the financial news we absorb. The majority of news headlines and television talks are designed to build excitement and elicit our emotions in order to motivate us to do anything. Owners of stocks, on the other hand, are far too often influenced by the unpredictable and frequently irrational conduct of their fellow investors, leading them to behave similarly. In light of the abundance of information available on financial markets, the economy, interest rates, stock price behavior, and other topics, some investors believe it is critical for them to pay attention to pundits, and, worse than that, it is critical for them to consider acting on their advice. Billionaire investor Warren Buffett. Investing isn't rocket science, but there is no easy button. One of the most common myths about investing is that only highly educated individuals are capable of selecting profitable investments. Raw intelligence, on the other hand, is widely considered to be one of the least predictive indicators of investing success. You don't have to be a rocket scientist to do this. When it comes to investing, it is not a competition in which the guy with the 160 IQ wins over the guy with the 130 IQ. Billionaire investor Warren Buffett. Although it is not necessary to be a genius to follow in the footsteps of Warren Buffett's financial philosophy, it is surprisingly difficult for anyone to continuously outperform the market and avoid making behavioral mistakes. Investors must also keep in mind that there is no such thing as a magical set of rules, a formula, or an easy button that can provide outcomes that outperform the stock market. It does not exist, and will not exist in the future. According to my standards, anyone who claims to have such a system for the sole purpose of drumming up business is either extremely ignorant or no better than a snake oil salesperson. Be wary of self-proclaimed gurus that promise you a hands-off, rules-based approach to investing that is anything but that. If such a system were to actually exist, the owner would have no need to sell books or memberships to anyone. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.